This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thanks so much for the continued support and for tuning in. If you enjoy the show, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps more folks discover the MicroCap community. By the way, I'm recording this little intro here on Wednesday, November 26, 2025. So listen, just wanted to give a quick thanks to everybody that has ever listened, downloaded, just spent time on listening to Planet MicroCap podcast and hearing our guests and learning more about what's going on. I mean, it's you that really makes this community. So just wanted to give a quick thank you, wishing everybody a happy Thanksgiving for those that are celebrating. And just truly thank you. A little quick, just getting some stuff out there as well. Registration is now open for the Planet MicroCap Las Vegas 2026 in partnership with MicroCap Club. It is taking place June 16 through 18, 2026 at the Bellagio in Las Vegas. It's the premier gathering for microcap investors, companies, and allocators. Visit planetmicrocapshowcase.com to register, and I'll see you all in Vegas. Now, my guest on the show today is Kenny Chan, founder and portfolio manager of Korwell Capital. Kenny is only 23, but he's built an investing philosophy rooted in the classics, Peter Lynch, Joel Greenblatt, Warren Buffett, and adapted with a modern high-conviction approach. His North Star, and I quote here, buy Phil Fisher-like businesses at Graham-like prices, end quote. Kenny walks us through the 4 categories that define his framework: misunderstood Buffett-like compounders, deep Graham-style value plays, capital cycle opportunities, and turnarounds. We discuss how he launched Korwell Capital straight out of college and how investing in his own convictions, not academic theory, drives his process. We dig into 2 examples that bring this to life. First, advanced auto parts, where Kenny saw a rare combination of capital cycle tailwinds, industry consolidation, and a fixable integration problem, creating a classic turnaround at a very cheap price. Second, Trubar, which we actually recorded this on Monday, November 24th. So it actually received the takeover bid on the day of the interview. So Kenny breaks down why he viewed the company as a niche brand with a durable moat, why the sale undervalues its long-term potential, and the critical lesson he's taking away: understand management incentives before you invest. We wrap with Kenny's advice for aspiring managers, especially the importance of writing publicly, testing your theses, and building a network through the quality of your ideas. We talked about a number of companies in today's episode. Kenny is a shareholder of Advanced Auto Parts and Trubar, and I am not a shareholder in any of the names mentioned. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Kenny Chan of Korwell Capital. Kenny, thank you for joining me today. How you doing, man?
Thank you for having me.
Absolutely. It's great to have you, man. Well, look, we met for the first time recently at our Toronto event. So firstly, thank you for coming. That was a lot of fun to hang with you and, get to know you a little bit more. I wanted to invite you on because, one, you just launched your fund very recently. You're young buck getting after it with the new fund and everything like that, putting out investor letters, all this stuff. And so just really wanted to have an opportunity to learn more about your approach to investing, your philosophy, and kind of go through maybe a couple ideas, stuff like that. I mean, we're recording this on Monday, November 24, 2025. So I know one of your core holdings probably definitely get into a little bit today. So with that, Kenny, for those that haven't met you before or know your background, where did your passion for investing begin, and how did that then lead to launching and founding your own fund at Korwell Capital?
Yeah, of course. And Bobby, it was a great meeting in Toronto. The event was amazing. But on me, I grew up watching my dad open a comic book store. So I think naturally I was always interested in business. And as I grew up, I started reading more business news and eventually caught on to some investing books. And so my first investing book was Peter Lynch, One Up on Wall Street, and it absolutely blew my mind. And that led me to start reading other books, like Joe Greenblatt's and Seth Klarman's. And I had these hour-long train rides, and every day from and to school, I'd spend it reading on investing. And eventually, even before applying to college, I knew that I really wanted to work in value investing. And so I eventually got admitted to NYU Stern, and it was a great opportunity there to test my ideas against classes and in different internship experiences in private equity and the hedge fund space. And I graduated with a return offer to private equity, but our fund ended up closing before I could start. And so I ended up in a small public equity shop. And, a couple months into it, I had gotten to know my boss very well. And I took the chance to ask him, hey, would you help back me if I started my own fund? And he said yes.
Heck yeah. So, I mean, I know you're 23, right? You're young. When I say young, but I'm like, this dude, man, I feel quite old, already. But I mean, what would you say gave you that confidence? I mean, again, you just came out of university. You were at the, public small cap equity shop for 3-4 months, something like that. And you're just like, you know what, I'm ready to already kind of go out on my own and get after it. What gave you that confidence to do that?
Yeah, I think, first, I just had the opportunity to say my former boss, who I'm great friends with, is a great person, and he had belief in me. So, part of it is just, it was just opportunity. And another part is, I think, going through education on modern portfolio theory and working in private equity, you realize that most of the industry has a different view of investing than what was taught to be through a lot of these value investors books. And to me, the most important thing out of my career is to be able to research stocks in the way that I believe, and ultimately to invest in my own convictions. So it was a more so confidence as though,
Well, do you think there might be something to that, Delta? I mean, you talk with investors all the time. They've been doing it a long time. They're like, hey, man, of course, you want to read the books to get the fundamentals, but then once you're now out there, it's different. So I mean, is it a do you feel that a little bit of like, you understand what they're saying, but you still are like, well, I get that, but I still have my convictions on how I want to go about doing this. You know what I'm trying to say?
I would say really everything I'm doing isn't new. I'm really just copying the insights from value investors before me. But the difference is that I believe I have a different perspective of their insights than most investors. And so you have your book like What Up Wall Street, and many investors have spawned from that book, but very few invest like Peter Lynch with 3,000 stocks in the portfolio, and looking at cyclicals the way he does, looking at industry data the way he does. So even though there's a common theme of education in these books, there aren't many that I'd say invest the way that these investors ultimately did.
Absolutely. Well, that's a perfect segue to dig in a little bit further on, your fund strategy, your philosophy. So give us the full pitch. What is the fund philosophy, and then what's the strategy that you are looking to basically enact that?
Yeah, I'd say in a high level, the way I invest is using a first principles understanding of business to understand a business beyond just its financial statements. And a lot of this is using what Li Lu calls insights, which he says there are maybe 10 or so insights that are why Buffett has outperformed value investors before him, like Benjamin Graham. And luckily for investors, a lot of these insights are public and you can learn them. And so my core thesis is buying Phil Fisher like companies at a Graham like price. This is something that Warren Buffett said before. or or buying Graham-like companies at a very, very cheap price. And so to be able to do that, it requires a deep understanding of the business to understand beyond the financial statements, to understand situations where a company stock price is temporarily depressed, although the business model is still very great. And so I'd say I have four categories. If I had to categorize them, four categories of investments. I have my misunderstood Buffett-like companies, high return on capital, and reinvestment opportunity, which are very rare at a cheap price. And then you have your Graham-like companies that are trading at a huge discount to tangible book value with management that's willing to unlock it. And you also have your what I call capital cycle opportunities, which is a methodology of understanding the cyclicality of industries. And so from these industry dynamics, you can have a company become a Buffett-like company, or you can have your cyclical companies that are trading at Graham-like prices, and lastly, you have your turnarounds that are these Buffett-like companies that have a temporary situation that's depressed their stock price.
Very good. So, I mean, before we get to some of, because one of the things I wanted to talk to you about today that you also hit me up on was, how Buffett really inspired you. I mean, inspires a lot of people who listen in or have been on the pod before, but there's a bit of even more sentimentality about that. I'd say, where we currently sit today, being that he already put out his last letter and kind of going quiet a little bit, but can you give us, before we get into that part of this, and maybe it'll dovetail, what would you say is, you don't have to name your best pick or anything like that, but like, what is that ideal setup for you amongst all four of those buckets?
Yeah, really the best investment opportunity, if I could hand create one, is really one of these businesses that can not only has a high return on capital, but can continue to grow its return on capital. And the way that can be done is through pricing power or structural changes in the industry. And an example I can give is during my fund launch, I invested and I still own a position in Advanced Auto Parts. And the aftermarket auto parts industry is one that's very interesting. You have when you hear cars, or businesses that sell car components, you naturally think that it's very cyclical. But there's an insight from Peter Lynch that kind of explains that the cyclicality is more so people deferring their new car purchases. And when they defer their new car purchases, what do they end up doing? They end up fixing up their old car. And so when you look at the businesses in the aftermarket auto parts industry, you have your AutoZone, O'Reilly, Advanced Auto Parts. These kind of businesses were able to maintain their margins through recessions, through tariffs. And so I came in during Liberation Day tariffs, and I saw that Advanced Auto Parts was at extremely depressed price, and it was a good pickup. But another thing with that industry is that the industry has rapidly consolidated in the last 2 decades. And if you look at historically, in the 2000s, there were thousands of mom and pop aftermarkets auto parts stores, and all of those got consolidated into these 4 players today. And what that resulted in is you have your AutoZone and your O'Reilly doubling their operating margins from the 2000s to today. And their stock prices since IPO have compounded at around 25%. Advanced Auto Parts used to be the biggest player, but they had a few hiccups really because they failed to integrate their acquisitions. And now there's a manager who understands that and is willing to fix those issues. So you have an opportunity to buy a very good, great business, high return on capital, potentially at a very cheap price.
Very good. So, one thing that, I guess as we pay homage a little bit to Buffett and some of Berkshire's best investments were, him looking at and finding some of these misunderstood microcaps. Do you apply that I guess you'd say that strategy, that essence,
Mhm.
you know, how do you apply your way to find what, you know, were those misunderstood microcaps for Berkshire and then say, all right, these are now my Korwell Capital, you know, core ideas.
Yeah, I think I could break it down through two insights that Buffett had that I think is core to almost all of his investments. You know, the first being, let's talk about Geico, and the insight that I'd call this is what Nick Sleep eventually calls shared economy scaled. So where a business foregoes, quoting the highest price for their product, and instead depends on volume to match that decrease in price. And these are low cost operators like Geico itself. And you know, when you look at Berkshire's history, Geico might be the most important investment Buffett's ever made. He bought this initially for Berkshire in 1976, and it was going through a terrible time, almost going into bankruptcy. And at the time, the market cap was maybe 100 or 200 million, a clear market cap. But Buffett understood the reason why it got to that point was that its managers took on terrible risks that they weren't familiar with. The traditional business model of Geico was to underwrite auto insurance for government employees who were safer drivers, who had higher renewal rates, and they use a direct mailing method of distribution. So their costs were the lowest in the industry. And what they've done is they've expanded to non-government workers and other lines of insurance. And if you look at the financials of Geico, the 1 year in 1975 wiped out, I believe, around 70% of its equity value. So it was such a terrible business that if it had gone, lost, it continued to lose as much for a few more quarters, it would have been out of business. And despite this, Buffett put in at least 25% of Berkshire's equity portfolio into the company in the form of preferred share and common shares. But nonetheless, if the company continued to lose, at this pace, his entire position would be wiped. And so at first glance, you look at a company like this and you think this is an awful situation. Any portfolio manager today that invests like that would probably be fired. But he understood, he had a good relationship with past managers like Echo. He understood the core business, selling to government employees at the lowest price, still was there, so still present. And that's when I think about investing today, there are tons of situations like this where you have a great business model hidden underneath a couple of years of mismanagement, and a new manager that is understanding of the industry dynamics and can reverse a lot of the damage that previous management has done.
Absolutely. No, I very much appreciate all that. So that's really cool to hear. Yeah. Hey, listen, man, even on the young bucks, man, lessons learned from the 50s and 60s are, taking effect and being put into practice. So, I mean, do you have any examples, let's say other than Advanced Auto Parts, where you took those insights and were like, all right, I see a lot of these similarities in this idea, or, again, you can say the name of the company if you want to or not, it's up to you.
Yeah. I'd say, in today's market, it's hard because a lot of the bigger companies are already priced. Costco's at 50 times. Costco is a very similar model that Nick Sleep found. I'd say today, I don't own this, but Wise, the payment company in the UK, is a very similar model. Its price got cut a little bit because they intentionally decided to lower their margins to provide a better product for consumers, and that's a textbook example of the shared economy scaled. Having the lowest cost product out there and allowing volume to overtake the difference in price. And in microcaps, there are a lot of companies that are trying to copy the Costco model, the Geico model at a smaller scale. And if you can understand their businesses and understand the management team and how they think, you can get these businesses that will develop into something like a Geico or Costco at hopefully a Graham-like price.
Absolutely. All right. So I have to ask, like today, again, we're recording this Monday, November 24th. One of your core companies, Trubar, announced a bid to be acquired this morning. I'd love to hear what are some of the lessons learned or some of your insights from that experience. Because Trubar is an interesting case study, I feel, in kind of the microcap consumer brand, and it's what attracts investors to it, the risks that are involved. So I'd love to hear from your perspective what that experience was like, how you found it, why you had the conviction, and then maybe even some commentary on what some of the news today.
Yeah, of course. I always like to read investment reports online and look at insider trading. So Trubar popped up a couple times throughout reading and screening for insider buying. Initially, it looked like a special situation out of Joel Greenblatt's book. There's this terrible business that primarily did cannabis that got rid of its terrible cannabis business, its terrible skincare business, and it is revealing this very promising protein bar business. And naturally, for these kind of restructuring situations, people are turned away. The old financials don't reflect the financials of the standalone company. So I took a look. I noticed the high insider ownership. I noticed the incredible growth in this company. If you take the standalone revenue by itself, they've been doubling revenues for a couple of years with no marketing, very little trade spend. And so when I looked into this company, I noticed, protein bars are a very competitive industry. So how come they've been able to succeed so handedly? I looked at the history and I realized this protein bar was created specifically for women. You look at the protein bar market today, and the ethos is protein maximization. So you have recently David Bar came out that tried to jam as much protein bar as they could into a bar. But when you talk to women, you realize that they don't want 25, 30 grams of protein in their protein bar. They want a good amount, maybe 12 to 16, and then fiber and these other kind of macronutrients. So looking at the market positioning, there's very few protein bars. I believe when I spent time looking, Trubar was at one of the largest already that was clearly targeting women. And so, they have this great third-party distribution model. They've already started creating this very promising brand. And at its price, it was pricing it as a very speculative investment, maybe because of the cannabis past. And so I made that position for the fund earlier this year. Today it came out with a takeover offer. Nothing of the sort has been mentioned during earnings calls, and it looks like they're trying to push this through very quickly. And the price given, around 2.2 times last 4 quarter sales is very disappointing in my opinion. I think when you buy a brand like this, the certainty of the brand succeeding is due to its market position and what the promise is to consumers. So, Warren Buffett always says a brand is a promise. And when you look at, there's certain anomalies in the branding world. Why do people buy Coca-Cola over Pepsi when they essentially taste the same? And in the past, Pepsi was actually only in operations because they sold at a lower price. It's because of the marketing and the brand building they've done throughout decades to have this emotion evoked out of you when you buy a can of Coca-Cola. You get this sense of nostalgia, you get the sense of happiness. That kind of branding is a moat. It's not something you can see in a financial statement, but it's an incredible barrier to entry. And when you have a brand like Trubar, where this is a kind of like capital cycle opportunity. All the money is flowing into the protein dense bars. Not much is going into this woman focused niche. And they're starting to build this brand that's, clearly the sales are showing that it's resonating with its end consumers. And so you have that margin of safety from the brand positioning, not necessarily from the assets on its balance sheet or the earnings that it's generating right now. And to kind of cut that story off at 60, 70 million in sales is very disappointing, because it's my belief that this Trubar will be able to continue to grow, and by selling it off so early, you're losing a lot of value that could be generated.
And listen, I respect that. Listen, you put together a big thesis, right? You made it a core position. You thought that there was clearly some more runway there to be unlocked. But may I push back?
Yeah, of course.
Respectfully. No, but I mean, look, I have no dog in this fight. I'm not a shareholder or any of this stuff. So but it's interesting, and having spoken with a number of CPG companies in MicroCap over the years, and look, to push back, like for instance, on your Pepsi Cola example with that, like, brand's been around since 2019. It's not like this has been around for that long, and with how quickly and how many, how competitive this space is, it's nice that you kind of carved out this, marketing niche. Like, this is but like that can be fleeting as well too, right? Like, we've seen many amazing marketing strategies that we thought were brilliant at the time, probably generate a lot of revenue, but then, over time, and in this day and age, it's usually much faster than it was previously. That now thesis or that market, but it just doesn't work anymore. So I'd be curious your thoughts on that front.
Yeah, absolutely. When you look at protein bars in aggregate, it is very competitive. But in this specific niche, and this has been reciprocated by industry reports like Mintel, there are very few protein bars, for whatever reason, that are focusing on the characteristics that target women. Taste, this lower protein count, fiber, and it's really part of the capital cycle framework. So the idea that the trendy things that where capital is being shoved into will be more competitive and returns will go down. Like looking at brands, despite the success of Trubar in the past couple of years, it's at a small scale, so maybe hasn't caught on the attention of the larger players. But I'm shocked to see that no one else is trying to enter this protein bars for one niche. And as they delay that investment into this protein bar niche, Trubar is continuing to build a brand. It's continuing to invest in marketing and brand awareness and capturing what Buffett calls share of mind. So, if tomorrow a huge player came out and said, "Oh, we want to invest into a women's protein bar," that would be a considerable danger. But it's not. For some reason, companies just don't focus on these kind of untapped or maybe newer markets, and it's hard to imagine them.
Newer markets. Women have been eating protein bars for years. What do you mean, newer markets? Come on.
Yeah, but the industry reports talk about all
people have been eating protein bars for years. Sorry, I don't mean.
Yeah, of course. And I think that's the big misconception, because when I talk to people, predominantly men who are investors in Trubar, they don't understand the differences that appeal to women. And I think a lot of companies in general don't understand that. And so that's why they have this little niche that's been working so successfully. And it kind of explains this capital cycle missed opportunity. from the larger players.
I mean, again, not in playing devil's advocate too. I mean, but if it's part of kind of that falls in that bucket of the capital cycle thesis, isn't this then kind of a win? You're selling out before the bottom falls out in this trend of, investing in protein bar. They're a one product company, I mean, look, if you invested in it, when it was 52-week highs, like, that sucks. But like, for those that kind of bottom ticked it, this is kind of like a nice win on the cap if that's going to be your thesis, like, you're like, all right, the trend is still very much your friend in this case, but like, I mean, really, for how much longer?
Yeah, that's a good point. But when I think about the end consumer, women, I think their target audience is really moms. The trend of eating protein in aggregate has been very, very strong. It's hard to believe that these women will stop eating protein bars. And another like point of consideration is the valuation that you're getting this company at. When you look at big investments in the past, there are so I believe Nick Sleep had a big position in Amazon, and at the time, investors were kind of worried that margins are volatile, and that's being reflected here with the trade spend and marketing spend. So the valuation you're getting, if you consider 7 to 8% net margins or operating margins as a long-term achievable goal, the valuation you're getting is very cheap. So you have this huge margin of safety. And, if you think about the capital cycle and you're maybe putting into consideration that this trend will die out, which I don't believe with women eating protein bars, but what if another company comes out for brand, right? If you look at the company and its growth was cut in half, it's still cheap. It's just that margin of safety gives you that safety, that certainty that you need.
Listen, I'm not even going to try and push back on because you've done much more work than me on the valuation and fundamental side of the business. So like, I'm not even going to try and like, I'll take you at your word. So, you that bring up a point there. I'm just more saying on, I still think this is, probably the best possible outcome in some respects because,
right.
I don't know. Look, like I'm also just not. I think for me, this is my own personal opinion. I just don't. I'm not a big believer in like you're just marketing protein bars for like. I think women are they'll sniff that out a mile away of just like a marketing ploy versus like if this other bar looks healthier for me than this one, I don't care if this is for women. Like I'll eat that other bar because it's better for me or tastier or whatever. You know what I mean? Like that's really the risk you're running into when you're locking yourself in of like, this is a protein bar for women, like, listen, I was in Costco the other day because I actually hadn't seen one before. And I finally looked at it and like, I had no idea that it was marketed for women or whatever. I was just looking at the ingredients and everything. And I was like, this doesn't seem like something I would probably, and I showed it to my wife and she said the same thing. So like that's why I again, that's just my own personal anecdote, but like again, I think it might be kind of might have lucked out in some respects, bro. Like you don't have to waste any more time thinking about like the market dynamics of how this is being marketed. It's like, all right, valuation side of things, totally get that. But if the thesis is also this like marketing to women type stuff, hey, man, good luck,
Well,
like, have fun with that.
Well, I mean, if thinking that way, it's then almost impossible to imagine why people won't buy knockoff brands of Coca-Cola or Frito-Lay's. How come the brand has that much power that people are willing to pay for a product that tastes exactly the same, right? And I think that's the uniqueness of branding that. Buffett, with See's Candy and with Coca-Cola, his understanding of that is sort of predicting the future financial results.
Oh no,
right?
sorry, I don't mean to cut you.
Yeah.
I think like the brand itself,
Mhm.
the name, like I think it's a legit good name for protein bar. Um,
Mhm.
I guess it's more the marketing um plan, right? I guess that's really
Yeah.
where my critique is more on like how it's being marketed versus the actual branding itself. Because that's really the big difference when you think about it with like Coca-Cola and Pepsi is like how
Yeah.
is Coca-Cola marketed versus like the brand, like everybody would agree like, oh, Coca-Cola, Pepsi, like that's pretty cool looking branding, I guess.
Mhm.
It has the story, but like when you think about how it was marketed versus its competitors and why it won versus like that's a marketing critique versus you know the branding itself.
That's interesting. I'm not exactly sure what you mean there, but I would say that I mentioned Warren Buffett says brand is really a promise, um, and how the way you convey that promise, is through your advertisements, is through what the packaging looks like, and also at the core product, at its core, Trubar is like a low kind of protein bar, protein content
Mm,
uh, bar, that your moms, would like a lot more than like something like say a David bar
maybe
that has 25 grams.
for sure. Nah, look, I just find it a fascinating case study. It's
Yeah,
just this is one that's been I know a lot of investors I talked about with quite a few folks in the last 6 months. So and again I'm not a shareholder, I have no dog in this fight, but I find it pretty. What would you say has been the biggest lesson? I mean, I'm sure you're still kind of taking it all in. Like this all was just announced today, and it's not like it's officially closed or anything. But I mean, what have
sure.
been some early lessons or early reflections after this happened that maybe you might take into when you look at the next CPG name or some other
Mhm.
potential investment?
Yeah, it's you're right. It is early in the process, so who knows what'll happen. I'd say understanding the incentives of management is a big takeaway from this the situation. Kingsley Ward, family office, big incentive for short-term gains, as any investor is in the professional world. Which given what I believe, it's my takeaway that that's a big reason propelling this deal. Um, and yeah, I mean, from this particular deal, I'd say that's the lesson. And I'd say, there's a theme among value investors. I'd say that that also has, they share this unpopular opinion about takeover bids. And you have the one I was, writing about this morning was Norbert Liu, who wrote MVR in Joe Greenblatt's Value Investor Club. He had a position in Quinta, which was a Latin American beer brand that had untapped pricing power and for many years increased prices. He had the same kind of mindset where when Ambev came to take it over, and at a good price, he thought, the real winner in this deal is Ambev, not me. And as an investor, selling that position, now you have to think, where do you put the rest of your money, or where do you put your money now? And the kind of opportunity cost that's lost is huge. You can think of the person who sold See's Candy to Buffett after he generated 1.3 billion out of the company from a $25 million investment. At the time, I'm sure he was very proud of his sale to Buffett. But after that thesis executes, I'm sure he realized that that's a big blunder.
I mean, but at the same time, like would we could go back and forth on that on all of these, right? Where it's like, would the company have continued to grow at that increased pace if Buffett
Right.
weren't involved, or if Ambev didn't buy it? Just
Right.
personal opinion, especially just to maybe wrap on like, dude. got a nice
Mhm.
premium on a single product protein bar company. Like
Mhm.
200 million. Like, come on, man. Like that's all things aside, all valuation aside, like objectively, single product protein bar company for 200 million. Like that's not bad.
Yeah, I mean
Come
that's where
on,
I
man.
like to
Like,
start. Yeah.
just if we're just like, but dude, I get it from your end. Like look,
Yeah.
if your valuation was showing that it could have been worth more, hey.
Mhm.
But anyways, I mean, what would you say also has been just kind of reflecting more on it like an investing experience that really helped shape your career already so far.
Mhm.
I mean, you published a couple, you shared with me a couple letters. I mean, what has there been any other experiences that you've been like, oh, that was I'm really whether I made money or not on this idea, like this actually was very formative for me to like now think more like with Trubar, for instance. Now you're looking at management
Mhm.
incentives probably a little bit more closely than you probably previously did. Like have
Right.
there been any other experiences like that?
Interesting. I think, well, generally when I look at these, what I take away from the insights of the investors before me, Lilu has this thing where he says everything to the extreme, but he says, people who use these insights need a different type of DNA. And I see, sometimes I look at, a company like Wise where I can clearly see that they're using the Costco model, the Geico model, but the stock price still falls. So, in terms of using the insights of the investors before me, I think everything they've said still holds true. In terms of personal investments that kind of shaped me, I'd say with as a young investor, before I got the internships and started working professionally, I'd say just realizing the kind of companies that are out there with such huge price dislocations and mismatches with their intrinsic value, and being able to profit off them has given me the confidence that yes, although modern portfolio theory says that there's an efficient market or somewhat efficient market, there is real opportunity for investors to make higher than market returns.
Very cool. All right. Well, dude, we've covered a lot here today. This has been a fun reflection on, listen, you're just getting your start, man. Like you've already picked a winner, right? For whatever it's worth. Um, and that's, it's cool that I'm really getting the feel from you on this is that like, you know, you're one obviously you're very passionate for it, but like it's pissing you off that it didn't make more, which shows that you're like, let me find the next freaking one could actually, even crush it even higher. So like I it's pretty cool to see, man. I must say, like you're 23, just getting after it. Like, hey, you already made some couple bucks on this one. Like now it's just time to find the next one and or continue to do the due diligence on some more core holdings or reallocate to some other core holdings, right? So, I mean, for those that are listening in that might be in a similar situation or are maybe have been dancing with maybe starting their own fund but haven't done it yet, like what advice do you have to them, beyond the like just do it? Like what other advice do you have?
Yeah, I'd say the advice I give people is to start writing your investment theses and putting them online. And you know, really, my first investment thesis I put out, I was very fortunate to meet fund managers with decades of experience and talk invited to a conference and putting your ideas out there, testing them against other people, seeing what they comment. It's a great way to test your own skills and to meet new people. And occasionally you get the winners. Like for me, it was Advanced Auto Parts during April of this year, and the rebound after. That helps give you some credibility and helps connect you with fund managers as well.
Very cool. Well, Kenny, with that, where can our audience go and find more information to follow you as well as Korwell Capital?
Yeah, of course. You can find more information on my website, Korwell Capital, and I also write on Substack as fundamental.us.
Very cool. Kenny, thank you for joining me today. Really do appreciate it. Good luck, stay safe, and I look forward to our next update.
Yeah, of course.
Thank you.